Hello everyone, and welcome to our webcast. Before getting started, we have a short video for you that will cover all of the details you'll need to know to get the most out of this webcast.
Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin.
Welcome to today's webcast, Better Mileage for Your Business, Tax Dollars and Related Due Diligence Topics in Transportation. I'm Barbara Mead, a partner with Moss Adams and the firm's Transportation and Logistics National Practice Leader. I help privately owned transportation, logistics, distribution, and manufacturing businesses address various assurance and tax planning and compliance issues. I'm particularly excited about today's topic that will reveal opportunities to decrease your tax bill and increase your business value. Real quick, I want to bring your attention to our disclaimer. You're in good hands with our presenters today. Jennifer Young works with large multi-state companies, particularly transportation and logistics companies, to negotiate incentives, provide audit defense and settlement, performs entity simplification, and reviews multi-state nexus and apportionment studies. Burr Dalton works with business owners and managers to achieve their strategic and personal financial objectives, which may include pursuing acquisitions, raising growth capital, or achieving full or partial liquidity for owners through a recapitalization or sale of the business. As we talk about opportunities to decrease your tax bill and increase business value, Jennifer will start us off by talking about how to pay less state taxes by understanding the rules, with a specific focus on trucking companies. Burr will cover the last 2 bullet points addressing common due diligence topics, valuation and M&A related updates related to the transportation industry. I will now turn it over to Jennifer.
Thank you, Barbara. Let's kick things off with our first polling question. How should revenues be assigned to a state? In-state miles over total miles, intra-state miles over total miles, intra plus interstate revenue over total revenue based on miles, all of the above, or none of the above? We'll have about 30 seconds for responses. As a reminder, 3 polling questions must be answered during this session to qualify for CPE credit. We didn't have space on this slide, but I would have actually added another couple of methods, including what's a mile. Option not available to us today. Got about 10 more seconds. Okay, let's see the results. It looks like we have kind of a spread. I believe that item D, all of the above, is the most appropriate answer here, depending on the state law, and we will be developing that through the webcast. Let's start with a brief overview of state income tax apportionment. Each state starts with total taxable income. I find it helpful to think of taxable income as a pie, and then each state's laws determine where they slice the total income pie, and the slice is the amount of income that that state will tax. In a perfect world, all state laws would be consistent with each other, and all of the slices, even though they might be different sizes, would add up to one complete pie. This whole process is called apportionment. We are not in a perfect world, of course, and not all state laws are created equal. In the worst case, a taxpayer can actually end up paying tax on more than 100% of income. That would happen if state tax rules overlap, and so the same income is taxed by more than one state. Let's look in detail at apportionment rules as they would apply to a trucking operation. We've got a smaller trucking operation here. It operates in 4 states. It has 5 lanes. Each lane has the same number of miles, 500 miles, but it operates across different states. If we look at a sample year of operations, by some coincidence, they ran 20,000 trips in each lane. They had $5.24 system average revenue per mile. We have some pick up and delivery, or P&D miles, in there. Total revenue of $262 million. They have an OR, operating ratio, of 92, so their total taxable income is just under $21 million. Before we move on to how this company would assign its income to states A through D, states use up to 3 percentages to apportion income. The property percentage, payroll, and revenues. So it would be in-state property divided by total property, in-state payroll divided by total payroll, and then revenues divided by total revenues. Some states use property and payroll, but all states use revenue or miles. And so that is the factor we're going to be focusing on today. So let's look at how this company might apportion its income to report its taxes to states A through D. Many companies use a simplified method as a default, which relies on IFTA miles. IFTA is the International Fuel Tax Agreement, and all states use this for fuel tax reporting. So it's a 2-page form that has all of the states on it, and miles are reported in the state for equipment run over the road and total system miles as well. So this is used for fuel tax purposes, but some companies use it to report their income tax as well. They take the state tax miles off the IFTA report, divided by total miles, multiplied by revenue, and that's their in-state revenue. If we apply that to our operation, we can see that we are apportioning income to all of the states, and the slices of the pie here are different sizes, but they add up to 100%. And we pay tax at the state rate of a little under $1.4 million. This equates to an effective state tax rate, which is total tax divided by total net income, of 6.52%. You can think of that as your average state rate. This is under the default method. There are a lot of advantages to using the simplified method as a default. It's simple, it's consistent, it's easy to understand, and it's relying on information that your company is already collecting, so you don't have to go out and get any new reports. So this method confers several advantages, but there are some important assumptions that are embedded in the use of the IFTA simplified method. The most obvious one is that this method is consistent with state laws, that state laws will allow the IFTA methodology. Embedded in here also, though, is the concept that miles are basically interchangeable, that each mile generates the same amount of average revenue as each other mile. Are these assumptions valid? Is this true? With respect to the first point, which is consistency with state laws, there are some very well-established modifications to the IFTA method that have been used for years. One important modification is the Multi-State Tax Commission rules, or the MTC. The MTC is a group that was created by agreement of member states. The MTC has many very important functions, but one of them is to develop model rules for defining and apportioning income. It's important to note here that MTC rules are not laws, so in order for it to have effect, a state has to adopt that rule into its own statutes. That's important because it can adopt the MTC language as written, it can adopt it and modify it, or it can reinterpret it through the court process, or it can ignore it altogether. Let's take a look at what the MTC has to say about trucking apportionment. There is a regulation, it's in Article 4, Section 18, that's specific to trucking. If you recall, under our simplified IFTA methodology, we used in-state miles divided by total miles to come up with revenue. The MTC regulation has more of a two-step process to determine in-state revenue. It's the total of intrastate revenue and interstate revenue. Intrastate is fairly self-explanatory, but let's take a closer look at interstate. Interstate revenue is receipts from movements or shipments passing through, into, or out of the state, as determined by the ratio which the mobile property miles traveled by such movements or shipments in this state bear to total mobile property miles. Well, what does this mean? If we look at point number 2 a little more closely, it focuses in on receipts from movements or shipments. So embedded in there is the concept that if you have a non-revenue generating backhaul, that would be a movement that did not generate receipt, and those should be excluded. If we refine our small companies model to exclude some deadhead, we come up with different in-state and different total mileage. So we have different numerators and different denominators for our fraction. And if we run that through our model, we can see we get a slightly different tax answer. It's about $6,000 difference. Now, spread across the system, $6,000 is not a big change. Whether it's an increase in tax or a decrease in tax, it gets you a right number. It's consistent. But this is a fairly small operation, and so if it were increased by an order or two of magnitude, these numbers might get to be significantly different, and you'd want to be sure that you had the right data. That brings us to our next polling question. Our tax department, excuse me.
That's okay, Jennifer. I'll take the polling question for you.
Okay.
Our tax department regularly discusses operations data with our information technology group. The options here are yes, no, or I don't know. And while we're waiting for the response, Jennifer, I got a question for you. How do business owners determine whether their companies collect this kind of data, and how would they find the correct IT department or person within the company to help them with this?
That's a great point. Trucking companies, like all companies, have started collecting just vast quantities of detailed information, and it can be hard to know where to start. IT departments have grown, and in some cases, departments are even outsourced. But a great place to start is to start with departments that are already using mileage information in some form, like your fuel tax reporting group or payroll. If you can establish a connection with business development and route planning, that would also be a wonderful place to start. And they can point you to the entrance of the wormhole you need to start talking with the people who are collecting data you may not have even known existed.
Great. Thanks, Jennifer. Well, let's see what our answers are here.
Okay, it looks like a lot of our listeners have a great opportunity to start making some contacts with their IT group. It can be very interesting. You can find some really interesting patterns in your data. If we look even closer at the MPC rules and start thinking about data that is being collected now, that brings up some additional questions. One is, again referring back to MPC apportionment, it speaks to receipts from movements or shipments passing through into or out of this state. So you're starting with in-state activity. What if your receipts from certain lanes are higher than receipts from other lanes? Would the MPC provisions allow this kind of lane-specific apportionment? Even further, what if you can track receipts by shipment? Would the MPC provisions allow receipt-specific apportionment? And there's been at least one state case decision where a taxpayer argued it could drill in on revenues that were earned within the state as opposed to revenues earned in the whole system, and the state accepted that. Another question is, can a member state modify or ignore the MPC language? Because many states have, even members of the MPC. There is some controversy here. Taxpayers have begun arguing that a member state cannot unilaterally modify MPC language, but the context is very different from trucking-specific apportionment rules, and the taxpayers so far have not ultimately prevailed in this argument. If a taxpayer were to argue that the MPC, or that a state could not modify MPC trucking language, it would be a very steep uphill and really quite an expensive battle. If we look at just some sample MPC Compact members, for 15 members here, we can see that 8 of them adopt the MPC language for trucking companies as written. 7 of them modify the provisions, in some cases significantly. Michigan, I should note here, repealed their MPC language retroactive back to January 2008. The second significant modification here is that a state can define a mile in a way that's different from an IFTA mile. If you recall from our IFTA reporting, an IFTA mile is the mile that over-the-road equipment ran loaded or unloaded within a state. And so many states define miles for income tax apportionment. They adopt this for IFTA, but for income tax apportionment they have slightly different, sometimes significantly different definitions. Indiana, for example, defines a mile as a revenue mile without much more explanation. Kansas requires all miles loaded or unloaded. Michigan refers to ton miles. Missouri adopts the MPC language as written. If we apply these specific rules to our apportionment model, we start getting a slightly different tax result here. It actually dropped the tax by about $70,000 for an effective rate of 6.18%. The first glaringly obvious point here is that these results are completely and totally dependent on actual operations. There's no theoretical reason why tax would be lower applying individual rules versus the simplified IFTA methodology. And in fact, there are cases where it could be higher. We could end up with slices of the pie adding up to more than 100%. So a key takeaway here is that it's extremely important to understand what really understand what your data are telling you. It's not enough to just get a huge report from IT. Really talk, determine that the year you're looking at is not somehow anomalous. Also, you want to verify that there aren't big route changes planned that would really change the miles, change your ton miles in one state relative to another that would give you a bad tax result. While a state might accept shifting from the IFTA method to the more precise method that's in their law, a state will not accept bouncing around from year to year using ton miles one year, IFTA another year, depending on what gives you the better answer for that state. That's something that a state would cast a pretty cold eye on, I believe. So these are some considerations for actual freight movement operations, but many trucking enterprises have activities other than just strict movement of freight. For instance, truck leasing entities, they need to apportion their income. And especially in the past few years, logistics service entities, they need to apportion their income as well. Truck leasing entities is fairly straightforward. In general, total miles is a very valid way to apportion their income. Things get a little more interesting when we start looking at logistics services companies. When we're getting into logistics services, we start getting outside of the trucking rules that are based on miles and into the service apportionment rules. Service apportionment is very different from trucking apportionment. Some states require cost of performance. They look to where you're performing those services. Where are your people? Where is your data center? Where is the payroll and the equipment that's directly involved in providing services? And that will be where you'll source the revenues. More states, however, have started adopting market sourcing rules. This kind of flips cost of performance on its head. They don't care where you're performing the services. They want to know where your customer is and where your customer receives the benefit of your services. So that's a very different calculation from cost of performance. More states are adopting this market sourcing methodology. States are also beginning to adopt the principle of economic nexus. Most of us are familiar with physical presence nexus. Economic nexus says that if your economic activity within the state, which can include having a customer in the state, if your economic activity in the state is at a certain level, that state can tax your income. So you can actually have a tax obligation before even setting wheel within a state. As Burr will be discussing, strategic events in the trucking industry are quite common. Oftentimes, state tax concerns come up fairly late in the due diligence process, but some advance work early can save both sides quite a bit of time. If you're preparing for a sales transaction, it would be great to document your positions on apportionment. Document the mileage methods that you're using for your freight operations. So where are your miles coming from? What rules are you using in which states and why? Document your leasing operations. Especially document the services methods for any logistics services entities or your logistics operations. What method are you using to apportion that service revenue? As you go through this process, you may find that some trucking operations might have miles in a state but have not filed a state tax return, or some logistics operations, particularly in market sourcing economic nexus states, might have revenue sourced to a state and again haven't been filing a return. If you are going through this and find that you have undisclosed liabilities, you'll want to consider recording those in your books if appropriate. If your target might have some unrecorded liabilities, you'll want to talk about indemnifications when you're negotiating the purchase agreement. Whether you're the buyer or the seller, if there are either undisclosed liabilities, or even liabilities that are on the books but haven't been reported to states, consider a voluntary disclosure agreement or a VDA. With a VDA, a taxpayer approaches a state, usually anonymously through an accounting firm or an attorney, and typically through the representative, the taxpayer agrees to file 3 years or so of back tax returns. In exchange, the state agrees not to go back further. An important point here is that when a return hasn't been filed, a state is not bound by a statute of limitations. They can go back essentially forever. A VDA will limit that look-back period, and oftentimes penalties can be abated even up to 100%. So a VDA, whether you're a buyer or a seller, is a good way to define the scope of the liability and get it onto the books. Now, Burr is going to discuss M&A trends in transportation. So from more of a bigger picture analysis, whether you're the buyer or the seller, though, attending to some of these state tax issues and getting them out of the way early can ensure that whether you're the buyer or the seller, you get maximum value from your transaction. And with that, I will turn it over to Burr.
Great. Thanks very much, Jennifer. Appreciate you taking everyone through that. So one of the obvious questions that may be coming up right now is, well, due diligence, why now? I'm not thinking about doing anything strategically. As Jennifer mentioned, the events that give rise to due diligence are common, much more common than we realize, and they are frequently unexpected. So we'll be talking more in the context of somebody who may be planning to sell their business at some point in the reasonable near future, but the same concepts also apply to acquisition opportunities, which of course can come at any time. One thing we have seen is that strategic buyers in today's growth-constrained environment are aggressively approaching companies with an interest in potentially acquiring them. And as you may have seen, the private equity industry is also aggressively calling on companies in all industries, particularly within transportation. In addition, there may be a scenario where you're looking for institutional capital, and that's a situation where the investor might be somebody other than a traditional commercial bank, and they typically are providing a more detailed due diligence requirement than what you might see otherwise. And there are a number of other events that are strategic and non-strategic that actually may give rise to due diligence. So it's very much in your best interest to take a more proactive approach to due diligence and preparing your business, because that can reduce the business risk and thereby actually enhancing the value of your business that might come through any kind of strategic event. So at this point, we'll hand it back to Barbara to do a poll question.
Thanks, Burr. Okay, our poll question is, how prepared is your business for a third party to perform due diligence? The answers are, we're on top of it and have very little room for improvement. We're in pretty good shape, I think. And with very little time on these types of issues, we could be missing a few things. So while we're waiting for everyone to think about that one, I got a question for you, Burr. Business owners often think that the best way to build value in their business is to make it bigger. Is this consistent with what you're saying?
Great question. It's consistent with and actually complementary to that. So think of it like offense and defense. On the offensive side, the best way to build value is by creating an engine that generates a high growth series of cash flows that are highly predictable. But what happens is you have items that detract from valuation, which is most of what we'll be talking about today, and that's the defensive side of the story that we'll be focusing on. So if you play strong offense and growing the business and strong defense and protecting the predictability of those cash flows, you're going to maximize valuation.
Great. Thanks, Burr. Okay, we'll go ahead and submit our answers here. And okay, here are our results.
Good. Okay. Exactly what I was hoping for. Most folks are recognizing that there are some items that pop up that maybe hadn't been anticipated. And so it's important to take a step back, ask those right questions, use this material as a checklist, and reach out to those advisors that you work with that might enable you to uncover some of those things that could cost you a little bit later. So this is great. Okay. So given that we have a number of folks here on the line that are focused on trucking, we'll dig into this a little bit more deeply here. So as you get into due diligence thoughts, clearly the fleet is going to come up and be a huge topic. And if your fleet is a little bit older, maybe there's some deferred maintenance, those maintenance costs are going to end up in your projected financials on the maintenance line. And also increasingly large fleets are choosing to pursue more of a uniformity strategy, and to the extent that you're doing that as well to be able to normalize and minimize your maintenance expenses, that's going to be additive. And if you're taking a proactive approach to adopting some of the relevant technology like electronic logs, and if you're also fully compliant with the CARB and other clean air regulations, that's going to be certainly additive. And on the flip side, going forward, if you haven't done that, that's going to be something that will have to come out of your future projections in the form of additional costs. Other topics that will be critical is on the driver and safety side, especially if CSA scores go private. They'll be digging into that area. If you have strong projections, but you have had a challenge of recruiting drivers more than most and retaining those drivers, or if you don't have attractive incentive plans, that makes it harder to justify those projections. And also with regards to the contracts that you'll have with drivers and owner-operators. If it's all the same, then somebody who's looking to acquire the business will know what they're getting by reviewing a contract. And otherwise, they may not understand exactly what are the provisions for a series of different contracts that exist, which increases perceived risk, which again is going to be something that will be detractive to the overall value. A couple other points here, again, thinking about in the context of supporting the future growth in cash flows, look at your facilities. If you have a significant facility for which the term of the critical lease there is expiring in a year, you need to get that taken care of now to be able to support your ability to have that property going forward. Similarly, if you are maxing out your capacity and that doesn't support the projections that you have, you need to do something to plan for that now. You need to make sure also that you have some flexibility in the leases that you have. If you have a scenario where you're acquired by a business that has a complementary or an additional facility down the street and you're both stuck in long 20-year leases that have zero exit provisions, that's actually going to be detractive to value in the form of a negative synergy. And then look at any of the legal issues that could come up, whether they be environmental or accident-related, employee-related. At a minimum, there's an implied insurance element to that, but also those could be big hits to the business that will require indemnification or at least a discussion around that going forward. And then shifting more, thinking about the financial side of the world, if you have financials that are not as clean as maybe they should be, then that will increase perceived risk, which will in turn draw additional scrutiny. And there are a lot of examples where that can actually cost you. One is make sure that the accrual methodologies that you're using, particularly for contingent liabilities, are up to date, very transparent, and that you can back them up easily. Make sure that you're fully aware of all of your pension obligations and that those calculations are current. Make sure, especially with the new Affordable Care Act, that you're on top of not only compliance with those requirements, but also what are your obligations for current and retired employees as well, or even contractors as the case may be. And then most folks don't realize that when you negotiate a sale transaction, there's actually a designated minimum working capital that is required at closing. If you're above that when you close, you get a little bit extra. If you're below that, you have to pay a little extra. So it's to your incentive to actually clean up, write off some of that old parts inventory, make sure you're up to date on your accruals and not understating those, and make sure that you have a number there that you can maintain and feel good about. And then also if there are personal assets in the business, they will go with the business unless you've done things to separate those beforehand. Shifting to the income statement, there's a concept called the transferable income statement, which means the P&L that is going to be projected on a normalized going forward basis if you have professional management team running that business for you. So what that means is that there are a number of items that will be added back to get to what's called an adjusted EBITDA number, which is the basis for valuation. So any expenses that are more personal in nature that happens in owner-operated companies, of course, make sure those are clearly tracked so they can be added back. Make sure you're also tracking any non-recurring or extraordinary items that can be adjusted. If you are an owner and you're running $1 million through the business for tax reasons, that's great, but make sure that you know what a professional manager should be paid so that you can adjust that excess in the form of the adjusted EBITDA calculation so that you'll be paid for that in forms of value. And also from an equipment standpoint, if you were to pursue a major asset acquisition right now and then sell the business shortly thereafter, you may not be receiving the full benefit of that depreciation, which is something to think about. And ultimately, it's about creating a culture of transparency where all these adjustments can be tied clearly back to supporting documentation and ultimately to the adjusted EBITDA schedule, which again is going to be a key driver for value of the business. couple other quick things. Customer concentration, supplier concentration, not much you can do about that, but make sure that you're telling the story that decreases the risk associated with those. Make sure that you have very clean documentation to the rights to your IP, and make sure that you have enough insurance to support your projections. And if you have bought out somebody that had shares in the company before, make sure all of that documentation that evidences that you are in fact the owner of those shares is very clean, including at the board level, because that can become a big problem going forward otherwise. So now we'll shift into a couple of trends on the M&A side. But before that, Barbara's going to take us through another question.
Thanks, Burr. Great job. What is the probability of your company being involved in a strategic event in 2015? Your answers are 0. We don't want to buy anybody, and we don't need the capital, and we're never selling our business. Second one, possible. We periodically receive calls from potential investors or buyers or are presented with acquisition opportunities. And third, probable. We have some gaps in our offering that we need to address through M&A or by raising capital to develop our own solution. So while we're waiting for the responses there, for ESOP-owned companies, they have a valuation done every year for their stock plans. So how is that different from the valuation analysis you're talking about?
That's a great point. So there are other valuations that are done for stock option plans, for ESOPs, and depending on what the incentive is, that may be entirely different from the value from a strategic standpoint, because frequently an ESOP or a stock option driven valuation is going to be intended to minimize valuation versus, of course, with strategic or financial, as the case may be, the goal is to maximize. So very different methodologies that are used that come up with very different conclusions.
Great. Thanks, Burr. Okay, we'll submit our answers, and let's take a look at the results here.
Got it. Okay. Not surprisingly, it's this first category, about a third of folks that are crystal clear on what they want to do. The reality is opportunity presents itself, and that changes their minds. We hear this all the time, and so I think that people need to recognize that those unanticipated events, they do happen, will continue to happen, so make sure that you're ready. Okay. All right, looking for this to come up here. There it goes. Okay, so what are you going to do? Know your valuation. Have a good sense for what your business is worth, roughly. There's strategic valuation, which we described is the value if you were to sell your business to a strategic buyer, typically in your space. And that can include synergies, which is either revenue opportunities or cost savings that come about putting the two businesses together, which can play into that. Financial buyer valuation is what private equity buyers would pay. It's all about cash flows and the predictability of those cash flows to pay down the debt that they use to buy that business. Know the difference between a control and non-control valuation. The price that you would pay for a share of stock is merely to the rights for a portion of cash flows. The difference between control is that you are at that point buying the engine for those cash flows, and there is a premium that is applied there. And there also is a discount that is applied for privately traded companies because of the lack of liquidity in that stock. So have a sense for how those play into your valuation as well. Make sure there's a sum of the parts recognition with regards to the assets in your business. If you have a very valuable warehouse that's fully depreciated, that's going to go along with the sale of stock in your business. You may be better off separating that into a separate asset, or a separate entity rather, and leasing that back to the business to maximize value. And then think about the tax side. Make sure that you're minimizing the taxes that are paid in the transaction. And then we talked a little bit about synergies. And of course, the only way to actually know exactly what somebody would pay for your business is to go out there and test the market. But to have a good sense beforehand is a very powerful piece of information. Okay, so what's going on with valuation these days? Massive appreciation in the indices and multiples since the recession. The NASDAQ Transportation Index has increased by 220% through the end of the year last year. And if in the bottom here we looked at trucking, LTL, and TL. And LTL, for example, the multiples alone are 2.5 times higher today than what they were in the depths of the recession, and that doesn't even take into consideration the improvement in margins and whatnot that are also driving value. So while we would love to think that all of these trends will continue, the reality is we know they won't. And so, for example, if you were to grow your business by 30% in the next 3 years, but the multiples come down by 30%, then you're in no different place from a valuation standpoint than you are today. So something to think about. In terms of number of transactions, we are actually higher in 2014, or we were, I should say, than we were pre-recession. And there was a technical bump in 2012 that was due to tax changes. So we are actually at a recent historical peak. And if you look at the right side with regards to the trucking transactions for 2013 and 14, what we have is a decrease year over year in the number of liquid bulk transactions. Most of the bulk is liquid. There is about flat volume in terms of dry van and heavy haul, but still good interest there on both sides. Obviously, dry van, given the dynamics of the industry, is going to be the largest. And also refrigerated and expedited, we have seen quite a bit of increase in these over the last year or so, and a lot of conversations that we're seeing with regards to those as well, particularly in refrigerator.
For a question for you, these transportation M&A volumes the numbers look a little low, and because we hear about deals all the time. So what is or is not included in these figures?
Great question. The difference is that these are publicly disclosed transactions, and everybody probably hears about transactions happening within their community that do not end up in the public. What we found is that the trends that are dictated by these publicly disclosed deals are very consistent with what's happening out there. And so I think that you should take a look at these with regards to the trend as opposed to the strict numbers that they represent. But that makes a lot of sense.
Great, thanks. Yeah.
So what should we be doing now? We have a scenario where now you're armed with some additional information on what to think about. So think like a strategic investor. Take a step back, look at the cash flow profile of your business, compare it to others within the trucking industry that you would consider competitors of yours, and look at your projections to say, what does a 3 to 5 year credible projection look like for your business? And what does that exercise reveal with regards to the specific risks that are associated with your business? And then take a look at those risks and say, what is the probability adjusted dollar implications of those risks? And then think about things that can be done in the short term to mitigate that. And ultimately, it's all about performing your own due diligence on your own business now while you have the time to optimize those operations, because frequently, as we mentioned, these transactions are happening when we don't expect them. So a natural question that comes up is, I don't have time to do any of this. It makes a lot of sense. How can I take advantage of this knowledge? Lots of resources that are out there looking at tax advisors such as Jennifer, for example. You can bring her in to make sure you're reducing your state taxes and increasing your compliance. Make sure that you're aware of tax credits and incentives that exist out there. Make sure that you are fully compliant with any federal, property, payroll, or other requirements that you have, and make sure that your entity is structured in a way that is most tax efficient, so that were that unanticipated opportunity presents itself, that you're in a position to be able to act on it without giving up more in taxes that you need to. And on the legal side, bring in a labor attorney. Have them take a look at your forms, your payroll policies, your contracts. You would be shocked at the actual implications from a dollar standpoint of getting some of these things wrong. I've seen it, and it's incredible. Take a look at the contract forms that you have for your customers, your drivers, your suppliers. Make sure they're uniform. Make sure they're up to date with recent case law and lessons that have been learned out there. And make sure that you're doing this annually, or at least on a regular basis, to make sure that from a regulatory standpoint, from a compliance standpoint, and with regards to new laws that are out there, that you are fully up to speed. And then also work with your financial advisors, whomever they may be, to make sure that first of all you are understanding and thinking about the full menu of your strategic alternatives that do exist. Make sure you do have a good sense for the valuation of your business within a reasonable range, and do what you can to optimize the cost of capital. Obviously, having some flexibility there is absolutely important, but make sure that you're not leaving opportunities on the table as well from a cost of capital standpoint. So again, it's all about performing due diligence now and thinking about your business from a third-party perspective, because it may be an agency that comes in to perform diligence on your business, or a strategic partner through a joint venture. It may be that somebody is looking to potentially acquire your business, a minority investor that wants to come in, or it may be that these are tools that you want to have at your disposal in a situation where a great acquisition opportunity presents itself. So have your checklist ready, be thinking about these things, and clean up what you can while you can. So at that point, I will hand it back to Barbara, who will take us through some of the key takeaways.
Thanks, Burr. Great job, great information. So our key takeaways from today are: reduce your tax liability by sharing your data with your tax department, reducing your business risk and increasing business value. Begin preparing today, don't wait. And strategic opportunities are frequently unexpected, and the M&A activity is very high right now. So if you do have an opportunity, please feel free to reach out, and we can help you out on that. So I think thank you first to Jennifer and Burr. A lot of good information was covered. And as a reminder, a copy of the slides will be sent to you following today's presentation. And at this point, we have, say 5 or 10 minutes left here if we have some questions. In the bottom left-hand portion of the icon bar, you'll see an option to click on Q&A. Clicking it will activate a text box in which you can type and submit your question. We'll do our best to answer all questions, but if time runs short, we will follow up by email. Let's see here. So it looks like we might have a few questions in the queue. And this one is for Jennifer. The question is, our IT department requires a return on investment calculation for every new project. How would I estimate the tax savings?
That's a good question. And you can't, when you go into it, you don't know that there are going to be tax savings. What you do know is that you're getting the information that you need to get your tax filings right. And so it can be presented as a business risk reduction rather than, I know I'm going to save tax. You don't know that at the outside. It all depends on what your data tell you. That's why it's very critical to know exactly what, to know what information you're gathering and know what it says.
Great. Thanks, Jennifer. Here's one for Burr. Well, what you're saying makes sense. I don't have time to take on these internal due diligence projects, and neither does my staff. Hiring attorneys, accountants, and other advisors gets expensive very quickly, and somebody needs to manage them. I expect others are thinking the same thing. How would you respond to that?
It makes sense. No secret that all these advisors are expensive, but let's think about it this way. So if your business generates, let's say, $3 million in EBITDA per year, and the current valuation range, let's say, is between 6 and 8 times, then these items can be the difference between whether you're trading at or whether your business would be worth 6 or 8 times that EBITDA number, which translates into a $6 million valuation range. So you would have to, it would be very expensive to come up with $6 million worth of expenses in diligencing these items. So what I would suggest is hire someone to help out the CFO or whoever it is that's leading the drive on managing these issues. Typically somebody that can take that compliance role and run around the organization and get this information, keep track of it, work with the advisors is not a very expensive person. And I would be shocked if you did not see a very strong return on that investment. And having this done on a regular basis and somebody keeping on top of it can be very important, not just with regards to the overall value, but a lot of people don't think about the fact that the structure is critical. And these items that we're talking about today can also be the difference between whether you receive 100% cash up front in a sale transaction or whether a significant portion of that consideration is deferred for potentially a number of years or put into an escrow and made basically a contingent consideration until some of these items have resolved themselves. So it's absolutely worth spending the time and energy and money to make sure that you're on top of these things because it can really cost you a lot later.
Thanks, Burr. Here's another one for Jennifer. Our IT group is overburdened as it is keeping up with operations. Can a state force me to calculate ton miles if we don't maintain that data?
Well, if their law requires 10 miles, theoretically they could, or they could estimate your tax liability based on a number that they would impute. And if you are facing that kind of a situation, then your return on investment working with your IT group gets very high. You could also make an argument that if you're using, for instance, the IFTA method in all states and you're consistent, that methodology should that methodology is reasonable and is a reasonable approximation if you really can't get to 10 miles. If you can show that you're being consistent and show that that's reasonable, and if you really can't get the information, they may be able to accept that.
Okay. Here's another question for Jennifer. Can you really pick and choose what kind of miles or apportionment you use when you show the miles are available for other states?
Well, you can't. You need to look at the state law. So, if the state law specifies 10 miles, you would have a tough time using a different methodology unless you could demonstrate that 10 miles was so impractical and that your other methodology was consistent and was giving, a reasonable answer. You cannot bounce around from year to year within a state. You can't pick revenue miles one year, 10 miles another year. It's all about looking at what the state law is and fitting those laws to your data. No, you can't cherry pick.
Great. Thanks, Jennifer. One other question for you, too. What about moving and storage?
That's an interesting question. Moving and storage is kind of a specialized subset of trucking, and it has some specialized rules. So you'd need to drill in on and see what the state says about moving and storage, particularly when you're licensed for household goods.
Okay, great. One final question here from the audience. Will this cover airline apportionment?
That's a great question, and
based off of mileage?
Gosh, I feel like Mrs. No here. Airline it's such a different industry, and when you think about how an airline operates versus a trucking company, when a truck is driving across states, you've got a truck in those states, and you can say there are miles in those states. When an airplane is flying, say, coast to coast, the flyover miles, the potential for having a lot of miles in the denominator of your fraction that don't end up in any one state numerator really has the potential to dilute the apportionment fraction to the point where it's not representative of your income and it's distortive. And so many states have different rules for airlines that use different metrics. A state may require arrivals and departures, so that's sort of a simple count as a measure, or block hours, or touchdown, only miles when there's a touchdown in the state. So the trucking rules cannot be applied to airlines without looking, again, at the specific state law. It's all about looking at specific state laws rather than coming up with a mileage method and then forcing it out.
Well, thanks, Jennifer, and thank you, Burr. Well, I think that brings us to a close today. Thank you for joining us, and thank you to our presenters, Jennifer Young and Burr Dalton. We'll follow up via email with a copy of the slides, as well as contact information in case you have any questions for the presenters. Thanks again for joining us, and please take a moment to complete the 1-minute survey. The survey link is there on your screen.